The last couple of weeks, the markets have been very, very boring. Volatility is super low, not just in crypto, but also the volatility index is at very, very close to lows before the March 2020 Black Swan event. So in this video, what I've done is I've put together a whole lot of pieces of data and created a thesis on what I think could lie ahead for the markets. Not just in the short term, but for the rest of 2023, 2024, and potentially even beyond that. So I hope you find this interesting. I found it interesting looking at all this data and kind of piecing it together and put together some sort of conclusion that either way, whatever ends up happening, that you have this information and that you are more prepared for potential scenarios, whichever way it ends up playing out. And I do think, spoiler alert, that in the short term, we might be looking at more downside here for 2023, but I do think there is a lot of potential upside coming after that stimulus money printing. So these are the scenarios that I want to prepare you for, and that is why I've created this video. So let's dive straight into the chart into my computer. If you like this, please smash the like button. And as always, feel free to leave a comment with your thoughts. If you disagree with anything or if you want to add in your thoughts, that is always welcome. Leave a comment down below. So the agenda for this video is as follows. What are we looking at for 2023? Is there potential for a crash or a black swan event like March 2020? Let's look at the dollar index. Let's look at some of the stock index charts. Let's look at the Fed rates and some various other data points for some guidance. And then is there a possibility of potentially next year after that crash, if that does play out, massive stimulus once again, just like we saw after the March 2020 crash, quantitative easing, massive bull market. Let's look at the roaring 20s, if it is possible that we are going to see something like that again. And if that were to occur, would we get a greater depression in the 30s where everything gets destroyed for like a decade? So let's go through this. Grab your favorite beverage. It is going to take a little bit of time, but it should be enjoyable, at least if you enjoy this topic, just like I do. All right, so why are we looking at the possibility of a potential black swan or market crash event, as the last couple of videos on my channel over the last weeks have been hinting at? Well, number one is we have this piece of data, which is the VIX, which is the volatility index. Okay, now this is not directional. It does not matter if the price of markets go up or down. What matters is just that they start moving. Okay, so when there's super low volatility, it basically means there's very little movement in the markets. And you can see now this volatility index has hit the lowest level since January of 2020. And as we all know, we got this massive spike in volatility here, as you can see, but that was when all the markets crashed. Again, volatility is not directional. It can massively pump, it can massively dump. Either way creates volatility, and that is what we're looking at. So when it is this low, we are more likely to see a very big move coming. The longer it stays lower with minimal volatility, the greater the chance becomes that we're going to see a massive move. Now we are going to look at charts technically later on too, but I want to show you this data first. So there is lots and lots and lots of data. If you're inside the VIP membership, you know I'm sharing this almost on a daily basis in much more detail. So guys, if you're not part of VIP and you want to join the Discord, the link is in the description down below. Come and join us. And you'll get lots and lots of this data if you like it. So you can see here, bankruptcy filings could potentially here be an indicator, not just as a standalone piece of data, but combined with all the other charts and all the other pieces of data that is all pointing towards things kind of being at some sort of extreme preceding previous financial crisis. Okay, you can see here in 2008 and in March 2020, we just hit that same level. Now, obviously, there's some sort of logic to this. Bankruptcy filings means people are desperate in a larger way, as a larger sample size of the population, and it's just an indication of where things are going. If people are filing for bankruptcy, it means there's no spare cash available. So where is the money that is going to go into markets? And if people are filing for bankruptcy and things are getting tougher, what do you think people are going to be doing? They're going to be liquidating any investments to be able to try and pay for stuff or whatever they still have left, right? It's not like they have money that they're going to start putting into the stock market when things are so difficult. So that's just something to keep in mind here too. Then we have something else that is a potential indicator. The 2-year treasury yield here rose to 5.08%, the highest in 16 years. inching its way closer to the highest level since 2000. You can see over here, we had a peak. This is the highest level since 2007 now. Obviously, that was just before the financial crisis. And in 2000, the previous financial crisis before that, it was even higher. So we're at the similar level. So again, all these data points are pointing towards, things are starting to get overextended. This is the same thing, just a different person posting this. You can see over here, similar way, July 2006, same level here, and then obviously that is even higher. The treasury yields are just indicative of, where things were at that point in time before the financial crisis and where we are right now. Another thing here, rising credit card debt. Is that a sign of strength or weakness? You can see rising credit card debt. What has happened in the past? Rising debt leads to here in 2007, 2008, obviously global financial crisis. Here, credit card debt increasing in March 2020, it dropped to negative, and now we're increasing again at higher levels than previously. Again, not a good signal. Then what we also have here, the retail money market funds have crossed $1.5 trillion, highest level ever seen. And you can see here, obviously it can keep going, right? But just showing you here at peaks, here just after 2000, and here also going to 2007, 2008, 2020, you can see it peaked in there. And we're here, maybe that's also something to look at. So it's all factors to consider. You can see here personal interest payments have surpassed $500 billion. So that's obviously the interest being paid on debt, which, if spare money is going to be paid to service debt, that's obviously money that doesn't go into the economy. That's money that, it doesn't go into the stock market and so on and so forth. So that's also taking away from there. And that is just massively increasing lately. Let's take a look at the dollar index, because there does seem to be a inverse correlation between the dollar index and the stock markets and crypto and risk assets in general, or any asset really denominated in US dollars, for example, gold, US dollar pairings on Forex, etc., etc. Okay, so if we zoom in more, especially say the last 5 or 6 years, right, we have seen this inverse correlation here where the dollar index goes down and we got our crypto bull market. Then it went up here and it bounced and we got the whole bear market here for 2018, right? When it dropped here, the entire 2020 bull market, and this entire move up was our 2022 bear market, okay? So let me get rid of that. You can see we have had a bounce here basically the last 2 months or so, and that is when we've been seeing struggles in risk assets. Now, if this continues going higher, and the problem here is if we put on the 50 moving average, once this reclaims it, you can see here, that was the bear market. Once it reclaimed it here, big move above, bear market. So we are moving here into a territory where it has reclaimed it on the weekly chart. And if this potentially continues higher here, maybe back to the Fibonacci golden pocket, maybe even higher all the way back to this peak, then we are looking at selling pressure on crypto, on the stock markets, on Forex, dollar pairs, etc., etc. Okay, and that is completely a possibility. This is something to keep an eye on. Now let's take a look at the S&P 500 on the weekly chart. As you can see on this weekly chart, there's clearly a bullish trend still going on. Okay, we're still making higher highs here, we're making higher lows, with the exception of March 2020 here. We are making higher highs and still made a higher low compared to this, but we are seeing some chance of failure here. Now, we are still here above the 50-week and the 200-week moving average. So things only start to get really dangerous. You can see in 2008, we got below the 200-week moving average, which at this point in time is about 39.25-ish, okay? Obviously, getting below the 50 is already a bit of a bearish sign. Getting below the 200-week moving average here would be a bearish sign and really a potential for global financial crisis. As you can see, we are not there yet at all. Yes, we have gone down a little bit the last several weeks here, and it might be the start of more downside. Yes, that is a possibility, but keep an eye on this 39.24. If we lose that, then things start to become more dangerous for the downside. But you can see what happened here in March 2020, and that's why I'm saying we might not get a full-blown financial crisis just yet, but what we could potentially see is something like this, where it happens very quickly. It drops, it slices through all these moving averages, right? Due to, obviously, some external event is going to be the catalyst, whatever that's going to be, whether it's a bank failure or whatever, I don't know what's going to happen. But something will happen, and then we could see it drop all the way back down, and then maybe they step in, the banks, the central banks, the government, whatever it is, start printing money again, and we see this massive run to the upside. I do think that's a possibility, but that means in the short term, there is this potential for us to see downside, maybe 10 or 15% in stock markets. It would cause a lot of panic, especially if whatever caused it is a fearful event or something, like some global event. That is a possibility here. Obviously, we want to see continuation above this level for the bullish trend. But here, right now, I do think something like this is a possibility. I don't think we're looking at an event like 2008 just yet, simply because that also only came after they started cutting the interest rates. The same thing in 2000, it only really came after they started cutting interest rates. So that brings me to switching over to this, the meeting probabilities, basically what they're looking for in terms of when are the rates going to cut from their current levels at this point in time. You can see, based on this, they're looking at about the end of July for a potential rate cut. Okay, so that is still almost 1 year out, meaning that basically the previous two major financial crises in 2000 and 2008, they only came after they cut rates. So if that happens again, and if that is really the trend, then we're not looking at that financial crisis just yet until potentially sometime in Q4 of 2024, or maybe even later. And you can see here, Goldman Sachs has actually pushed its forecast for the rate cut all the way to Q4, so even later than what I'm showing there. And you can see that is what they're projecting. So that leaves for the potential for us to continue higher. Now, for us to continue higher, like I was saying, I showed you earlier, the data looks bad for retail. So for things to go higher, we need liquidity. Where is that liquidity going to come from, right? How are they going to start doing that? How are they going to start injecting liquidity? If, in my opinion, there's no external event or catalyst that causes that, it's unlikely that they just suddenly start to announce that they are going to start printing a lot of money, right? But remember what happened in March 2020. We got this external event, everything crashed, it looked like everything was going to melt down. That's a perfect chance to step in and say, hey, listen, we're going to save this, we're going to start printing money, we're going to start injecting money, we're going to do stimulus, etc., etc. And we got this massive move to the upside, which you can see from March 2020 until December 2021, created this huge rally over here. So again, it's just guesses. I mean, ultimately time is going to tell if this is going to play out or not, but this is basically just trying to piece this together and creating some sort of thesis for what is going to happen potentially, right? So potentially, again, we can see a crash here, some external event, something happens, maybe it's a bank crisis, bank failure, they step in, you know, we see short-term scare, panic, again, something like this in the risk assets. So obviously I'm showing you the S&P 500, but it will probably be a global thing across the market indices, gold, crypto, etc. And hopefully it would be something like this, where we see that short-term drop. That's very scary. They stop in, they bail it out, and we see continued upside for another 12 months or so, until maybe they cut rates at the end of next year, and then maybe sometime in 2025 we see a real crash. That is a possibility. Keep in mind also, next year is the elections in the US. So, you know, I think it's unlikely that the markets are going to crash right before or during the elections. So then we have Bob Lucas on Twitter, and he obviously has a big following, and he has a good track record for making predictions on charts and cycles. And he's basically just said recently also, I like to think that after an induced slowdown into Q1 24, that we set the scene for a terrific roaring 20s broad bull market driven by massive AI and tech productivity gains. The rate of change in the tech and the real broad disruption is so hard to ignore. So that brings me to the next part of this video that kind of lines up and backs up or creates some confluence with everything that I've said so far, is that there is this potential for short term, some sort of induced crash, right? Or at least choppiness. So basically that could mean whatever. We don't know what it's going to be. Some sort of external event, yes, maybe just crashes the markets, or maybe it's a slow grind down for the next couple of months. Okay, that's also a possibility, but I'm leaning towards something just more towards something that creates a reason for the banks and the authorities to create more stimulus, to be able to inject that liquidity into the markets and keep it going for maybe another 12 to 18 months. Okay, that lines up with the possibility for the interest rate cuts in that time frame. No massive global bear market like 2000 or 2008 just yet. That'll come after they cut rates, okay, in my opinion, based on the data anyway. So short term, potential crash, some economic events, and then within the next 3 to 6 months, some sort of recovery and a massive bull market and melt up in risk assets, in stock markets, in crypto, and so on and so forth. So what was the Roaring Twenties? And he's referring to the 1920s. Okay, so let's just take a look at that. So after World War I, the pandemic, hey, sound familiar, guys? And the slump ended, Americans sprang into what was the Roaring Twenties. So you can see here on Wikipedia, it says the Roaring Twenties was a decade of economic growth and widespread prosperity, driven by recovery from wartime devastation and deferred spending, a boom in construction, and then the rapid growth of consumer goods such as automobiles and electricity in North America and Europe and a few other countries. So here at first, the end of the wartime production caused a brief but deep recession, the post-World War I recession of 1919 to 1920. Quickly, however, the economies of the US and Canada rebounded as returning soldiers re-entered the labor force. Okay, so there is no similarity in that sense, you know, where it was before all the major inventions and so on and so forth. Okay, completely different time, 100 years ago, obviously. Okay, we're aware of that. But look at the similarities, right? Pandemic, right? Okay, we had that. Possibility of a brief recession, right? Whether that's now or whether that's still a bit deferred, something is coming, right? Maybe it's a short-term crash. We are already technically in recession anyway. All the data is bad, okay? So maybe we get some sort of catalyst, we get that drop, like I was saying, they jump in, there's stimulus, there's production. AI and tech is definitely, there's so much interest in that, it's growing rapidly. So maybe with all of that going on, there is potential for some sort of melt up. Now, if that's going to last for the rest of this decade, who knows, right? I think that's a little bit far to project ahead, but maybe. I mean, for me, I'm looking ahead here. Short term, the next 3 to 6 months, the potential for a drop, some flash crash or something. Then hopefully looking for that melt up upside for, 12 to 18 months, all the way through 2024, maybe into early 2025. And then we have to see how things develop. If they do end up cutting rates, I would see that as a major warning signal from the first rate cut. That could potentially be some sort of signal for another bear market that could crash. But if we don't get that rate cut, if for whatever reason they keep rates higher for longer as they've been hinting at, and maybe they keep them higher for, who knows, maybe multiple years, maybe we get something like this. So that brings me to a point way down the line. And then obviously after the Roaring Twenties, we got the Great Depression of the 1930s, right? So you can see here, the Great Depression, 1929 to 1939, was an economic shock that affected most countries around the world. It was a period of economic depression that became evident after a major fall in stock prices in the United States, right? So the reason why I'm bringing this up is that we have for the past basically like 20 years have known an up-only market, maybe even longer than that, maybe 30 years if you look at real estate and some other stuff. But basically we have been in up-only markets, which means that, anyone who's basically in the millennial generation or younger has pretty much only known these up-only markets where, there's new industries and everything's growing and everything's booming. And we haven't really seen any sort of period like this where for 5 or for 10 years, the market goes sideways or lower and things become really, really difficult. So if we do see some sort of boom, whether that's going to last, 1 or 2 years as a bull market and then crash, or whether it's going to go on for multiple years, the point I want to make here is at some point we might see another greater depression, right? Things are not great in the world, as I've shown you with all these economic data points. Obviously, we're seeing inflation, we're seeing all this stuff happen. So if we do get some opportunity where things go up in a big way, be smart about it and do not think that things are going to last forever. If you get this opportunity, if we see a major bull market and you can make your money and cash out and set yourself up for future success, be sure to keep that in mind, that you put yourself in a position where if you are able to do that, that you can set yourself up, that you can weather a storm for 5 or 10 years of potentially very low economic activity, right? But if you have yourself sorted out, if you have a place where you can stay, or if you have income producing assets, multiple properties you can rent out, if you have land where you can grow your own stuff, if you have different assets, if you have skills, also very important, right? Who knows how the economy is going to go, but if you have skills, for example, like being able to trade markets, even in ranging markets, when things are trending down or sideways, there is still possibility to make money from trading markets, for example. And then, of course, any other skills that you have that are adaptable, right? So this is looking at, the next 1 to 2 decades. Think about that also. Try, and when times are good, really take advantage of that. And when you are up significantly, let's say in 1 or 2 years, we are up massively. Let's say this plays out, we get a melt up, roaring 20s, whatever the case is, and you are up seriously life-changing money. Keep this in mind. Consider cashing out, setting yourself up, setting your family up, because at some point we might see some really tough times that could last for a decade, and you have to be able to weather that and survive that. So skills, diversification of assets, and also just the ability to live within your means is going to be very, very important. Now, I actually wanted to look here at oil because it could potentially also be something that is a warning sign over here. I actually tweeted this back in September, this chart here when it was a little bit lower, that just based off the chart, without looking at any of the fundamentals, because I don't really know much about oil and how all of that works, but purely looking at the chart, what we can see here, from this low to this high, we had this where it went negative, it went to 0 on this chart, or whatever it is. Okay, it basically took the low here, right? It took the liquidity from all these points, and then it went here, it took out this liquidity over here, dropped back. So far here, we are seeing this act as support, and we're seeing this move. What if we see a massive move of oil? And you can see the date here, if this were to play out somewhere here between, say, middle or say beginning of 2025 to mid 2025. What if the target is for oil to go all the way up and just go to massively higher prices? In the same way, look what here happened. Look at the dates here, right? Started in Jan 2007. Look where oil peaked in the middle of 2008. And what happened in the middle of 2008? Yes, financial crisis. So that is what tends to happen here. If we get really, really peak oil prices like this, everything becomes so expensive and it leads to another financial crisis. This is another potential factor of confluence. Again, we don't know what is going to happen. I don't know what is going to play out, but based on this chart, if that happens, it wouldn't be strange technically, because it would be basically taking this high and taking any liquidity here. But real world, of course, that would be a massive stress on everything, because high oil becomes high gas prices for the regular person. Obviously all transport gets more expensive, which means goods get more expensive, and it just like messes everything up. So if we do for some reason over the next year or so see oil trending up and going towards that previous high, that could be a potential warning sign, canary in the coal mine for the coming global financial crisis that would follow it in the same way that it happened in 2008. And then another warning sign that I see that I wanted to share here too is the DAX. So this is the German stock index, and this is a weekly chart. What you can see over here in a similar way right? Look, this was the March 2020 Black Swan, right? Where it sold off. You can see what we had over here. We had a slightly higher high and a negative divergence here, bearish divergence on the RSI, and it led to a massive sell-off. Look what we're seeing here now, right? Kind of a double top, slightly higher high, but a bearish RSI divergence. This should be familiar, by the way, because that was also the double top situation on Bitcoin. Slightly higher high. Remember, it was 65,000. It dropped, came back, it went to 69,000, but with a bearish divergence on the weekly. And you know what happened after November 2021 on Bitcoin? It went all the way down, right? So this might also be another warning sign here for, in the short term, potential downside that could be coming here. And you can see all these different things that I'm kind of putting together to create this thesis. Again, I don't know if it's going to play out. Only time is going to tell. But I do think there's some logic base to this. And it's not just one single data point. It's the German stock index. It's the US stock index. It's the dollar index. It's the Fed rates. It's all this stuff together. And you can see. So the question is going to be, if this does drop, what if it is some sort of external event? That is kind of the theory that I'm leaning towards, because it would be quick. It would put a lot of fear in the market. Something, maybe a banking crisis. That's the most obvious thing. Some bank failure or something. Everything massively drops. There's a lot of fear, a lot of panic. Then they step in, bail it out, pump in tons of liquidity, and we see a 1 to 1.5 year upside continuation before everything really tops, followed by we'll have to see at that point. But that's basically what I'm looking at. So 2023 potential crash or black swan based on all these things in the next 3 months or so, maybe 3 to 6 months or so, is probably the window for that if I was looking at this, how I explained it. And then, like I said, 2024, maybe stimulus, QE, bull market, roaring 20s. We will have to wait and see if that's going to be the case. Personally, I'm not too sold on it. Bob Lucas seems to think it's a possibility. I would say let's just see if we get our bull market first and things all go kind of as I said here by the end of 2024 or sometime in the first half of 2025. If things look toppy and everything's euphoric and bull market, I would say, maybe there's a chance we get a global crash like 2008 somewhere in 2025, but we can see closer to the time. That's going to be very hard to, it's basically impossible to predict then. So roaring 20s followed by a greater depression, whatever the case is, the higher it goes and the more euphoria there is, obviously at some point that is going to be followed by a longer period of pain, because you cannot just continue to create debt and continue to inject more stimulus and devalue the currency at the expense of that. So at some point, the piper is going to have to be paid, and we will see if we get that bull market first. Be smart about it, guys. Be sure to set yourself up and cash out and take profits and set yourself up so that if we do see an extended period of Great Depression or bad economic activity for 5 or 10 years, that you'll be in a comfortable position and you'll be able to sit that out and have a good quality of life. And that really comes down to the actions of what you're going to be doing in the next, I would say in the next 1 to 2 years, in the next couple of years anyway. So let's see how this continues to develop at this point in time. Hopefully you enjoyed this information. If you did, smash the like button, share it on social media, point your friends towards this, and let me know in the comments, do you agree with any of this? Is there anything I said that doesn't make sense or that's incorrect factually? Please do share in the comments. I'm always looking to learn. Definitely not perfect, but I'm always learning here, and I want to share this with you so we can navigate this as best as possible and hopefully profit from it all and make tons and tons of money. Thanks for watching. Smash the like button. I will see you in the next video.